Let's jump right in. Valuation equals volatility risk. Welcome to this explainer. Today, we're putting on our trader hats to see exactly how dry, fundamental numbers are actually the secret fuel for explosive options plays. Let's unpack what we call the compression trade. Now, you might be wondering, I trade options, I look at charts and technicals, why on earth do I care about a PE ratio? Well, the truth is, fundamental valuation creates the hidden conditions for volatility risk. When a sharp trader looks at a PE ratio, they aren't looking at it like some long-term value investor. No way. They see a coiled spring. They're asking, how tight is this thing wound and what's going to happen when it finally snaps? The valuation doesn't set the option price directly, but it is literally the fuel for future volatility. Let's sketch this out on the whiteboard with some real round numbers. No abstract math here. Say you're tracking a $100 stock that's earning $5 a share. Simple division, right? That gives you a 20x PE. That tells you instantly that you are paying $20 for every one single dollar of earnings. For a trader, that number is a massive tell. It shows exactly what expectations are currently priced in. At 20x, the market expects solid, reliable results. But what happens when that multiple gets completely stretched out? Looking at this breakdown, the danger zones become super obvious. Actually, your eyes should jump right to that bottom row. A PE over 40x, that means extreme expectations. The market isn't just hoping for a good year, it is pricing in absolute flawless perfection. And you know what? Perfection is incredibly hard to maintain. Sure, anything under 10x might be a deep value play or maybe a dying company, but those high flyers over 40x, that's where an options trader gets really excited. Those sky-high growth expectations set the perfect stage for massive implied volatility if the company even slightly drops the ball. But what about early-stage tech companies, the ones burning cash with zero earnings? Well, for those, we shift over to the price-to-sales ratio. A reasonable PS usually sits right around that 1 to 5 times range, but the second you cross that 10x line, management basically has to walk on water to justify the price. If a stock is trading at 15 or 20 times sales, that is pure market euphoria. Any tiny hint that revenue growth is slowing down, and boom, that stock is in for a really severe reality check. Okay, so to adjust for actual growth rates, traders will use the PEG ratio. Check this out. Let's say a stock has a PE of 30, but its earnings are growing at 30% a year. 30 divided by 30 gives you a 1.0 PEG. That represents fair value. If a trader spots a PEG well under 1.0, they're immediately hunting for cheap call options because the underlying growth is actually being undervalued by the market. But on the flip side, a heavily inflated PEG is a massive red flag. So, what does this all mean for us? The absolutely crucial point here is that high multiples equals sky-high expectations, which translates directly into extreme volatility risk. A stock trading at 50 times earnings has a huge beta to market sentiment. Because the expectations are just so lofty, any minor disappointment, like missing a revenue target by a fraction of a percent, or just giving slightly cautious forward guidance, will trigger a violent price reaction. Simply put, the higher the valuation, the harder the fall. Let's walk through how this actually plays out. This right here is the core of the strategy. Imagine our stock is cruising at $100, earning $2 a share. That's a lofty 50x PE. They report earnings, and guess what? They still earn exactly $2. They didn't lose a single penny of earnings. But growth is slowing down. So the market suddenly decides this stock only deserves a 30x multiple. Do the math. $2 times 30 equals $60. The stock just crashed 40%. From $100 down to $60 with zero change in actual earnings. That, my friends, is multiple compression. It's a brutal valuation reset. Let's put a real ticker to this concept. Remember the infamous Peloton crash? Oh, man. At its peak, when everybody was panic buying indoor bikes, Peloton was trading at an astronomical 15 times sales. But as post-COVID growth inevitably slowed, a smart trader spots the fundamentals totally cracking under that extreme multiple. So they buy a $100 strike put option for $5, giving themselves a few months for the trade to play out. And as that multiple violently compressed over the next 18 months, the stock plummeted under $10. That put option they bought for $5, it exploded to over $90. That is an 18 times return on risk. Picture this payoff diagram we're mapping out right now. Your strike is firmly locked in at $100. Since you paid $5 for the option, your break-even line sits right at $95. As the stock price tanks below that line, your profit shoots straight up into the green. But look over at the Greek's callout panel. Notice how Vega is expanding massively? As the stock crashes and panic floods the market, implied volatility spikes hard, making the option even more expensive. You're winning on the directional price drop, and you're winning big on the volatility expansion. It's a beautiful setup. And that's what creates the ultimate asymmetric risk-reward scenario. Let's break down the mechanics. First step, you screen for the absurd. Look for those stocks rocking a 50x PE or a 10x price to sales. Second, you wait patiently for a crack in the armor, like deteriorating fundamentals or an earnings miss. Third, buy out-of-the-money puts, giving yourself a good 2 to 3 months of runway. Because you're buying when implied volatility is low and complacent, you get a double whammy benefit during the crash. The multiple compression drops the price, and the IV spike drastically inflates your option's value. Now keep in mind, this dynamic applies to entire sectors, not just single stocks. Think back to when the Fed was aggressively hiking interest rates. The market entered a massive value rotation. High multiple tech and growth stocks in the QQQ got absolutely crushed by multiple compression, dropping 33%. Traders holding puts there literally doubled their money. At the exact same time, capital rotated directly into low multiple value sectors like energy. The XLE ETF surged 65%, and traders who positioned with call spreads saw their positions triple. The valuation environment dictated that entire macro trade. So a focused trader always matches their option strategy to the current valuation regime. In a high valuation bull market, when PEs are expanding and everyone is happily chasing growth, implied volatility is usually dirt cheap. That's exactly when you buy cheap protective puts. But when the tide turns into a compression period, when those multiples contract and there's a panic flight to quality, that is the time to load up on long puts, bear call spreads, or VIX calls. And during a value rotation, you look at pairs trades, go long the value and short the growth. Let's wrap this up with a highly actionable checklist on when to use and when to avoid the compression trade. Use this strategy when you spot astronomical multiples, totally masking a slowdown in growth. Buy those out-of-the-money puts and give the trade 2 to 3 months to breathe. On the flip side, when to avoid it? Do not try shorting low PE value stocks. They're already compressed. And whatever you do, absolutely do not sell naked options when compression is imminent, because that sudden volatility spike will completely blow up your account. So, I'll leave you with this to think about as you look at your own portfolio today. Are those high multiple, high-flying stocks you're holding actually priced for the absolute perfection they demand? Or are they just a ticking time bomb waiting for one single earnings miss to trigger a massive, violent compression crash? Valuation isn't just some boring metric for long-term investors. It is literally the ultimate predictor of volatility risk. Review your holdings, check those multiples, and always trade what the market is telling you. Thanks for hanging out for this explainer, and we'll catch you next time.